Ireland's bond yields, the price it pays to borrow, are blowing out again as the results of the latest bank stress tests loom. The Irish government, already using European Union bailout money to recapitalise the banks and keep the country afloat, is expected to announce that the stricken lenders will need more cash. Some analysts hope the results will help ease lingering concerns. At least the worst will be out in the open. Others are not so sure, worrying Ireland is under growing pressure with the cost of the bailout and will eventually default. Here's Philip Lasker.
The Greek government is facing the reality of crippling debt, and this is the result. Spending cuts and striking doctors and teachers.
We're on the fighting line to keep everything from being lost. The government must fall, because if it continues this way, Greece will become a third world country.
Greece's credit rating has just been downgraded. Portugal's financial troubles deepened as banks' credit ratings were cut and its 10-year bond rate surged to unsustainable levels. Ireland will announce the results of its latest bank stress tests and reveal just how much more capital its financial institutions need on top of the €46 billion already doled out.
What Irish government is trying to do is to assure the market that they are dealing with problems in banking sector and they do have credit and money to address the underlying problems facing Irish Bank.
What's worrying some analysts is the new Irish government's pledge to renegotiate last November's bailout, with its implied threat to allow the banks to default if creditors don't agree. It all comes down to how much more money the banks need.
With the number being bigger and the alternative to a renegotiation being more pain inflicted on Irish people and taxpayers, it's not surprising that the new Irish government is looking for that can to be reopened.
The European Central Bank and also the European Commission will not allow the Irish government to simply renegotiate with their creditors their terms of assets and loans, simply because that will create chaos within the Eurozone.
The fear is that it would see Portugal and Spain push for similar concessions.
The European institutions do appear to be willing to negotiate with different governments, and the outcome may be different depending on the outcomes of those negotiations in the future. But I suspect it will be difficult for these countries in such great difficulty, under such pressure, to avoid pushing for bondholders to share in some of that pain.
In the US, the government and the central bank have been working closely together. The Europeans do not have that luxury.
This lack of coordination between European Commission and member countries and European Central Bank in effect is making market more nervous, is retarding implementation of swift policy to restore confidence into the banking system.
But right now, there's no sign financial markets see Europe's problems destabilising the global environment.
We've seen the Australian dollar striking new record highs at the same time as renewed concerns are emerging about European sovereign and bank debt. In May, June last year, when the Greek crisis first broke, the Australian dollar peeled off almost 10 cents. That's a sign, I think, that the global financial markets are seeing the risk falling where it lies in Europe, rather than necessarily being a source of global contagion.
The pessimists would say there's plenty of time for that to change.